China's deflationary phase very much needs a circuit breaker to jolt the economy onto a healthier path. Now, what we've seen out of the People's Bank of China and subsequent rhetoric around fiscal stimulus, it all feels very promising. Is it going to be the circuit breaker? Well, it's far too early to tell. What needs to change inside China is the confidence level of ordinary households and the translation into the real estate sector. That will really be the ultimate measure of whether this is successful. Commodity markets, financial markets have certainly voted positively in the last few days. I would say watch this space. Let's see some more detail on the fiscal side.
And so how long do you think it will take until we do know whether consumers are certainly happy enough to release the purse strings?
Well, it won't happen immediately, but we do get very high frequency data out of the real estate market. You have weekly data on housing transactions and sales. I would be looking to see some signs that there has been improvement over the coming weeks, but really the definitive signs you'd be looking for after the Chinese New Year in calendar 2025. So the Lunar New Year is January, February. It's how the economy bounces out of that period in March 25, April 2025.
For months, many economists had voiced concern China wouldn't be able to meet its 5% growth target. Why did it wait so long to deliver this level of support?
Well, I think that China has been doing a drip feed approach on the policy side. It's been experimenting, a little dollop here, a little dollop there, seeing what caught, seeing what the multipliers were. And there's been a lot of announcements going back all the way to the exit from COVID a couple of years ago. All of that is underwhelmed and disappointed. So now I think the authorities have lost a bit of patience and they are going for more forceful measures. But the US Federal Reserve's interest rate cut was also very important. I think the fact that the US Fed has now cut interest rates and is planning to do more, that reduces the risks, if you like, from the Chinese exchange rate side. That might have emboldened Chinese policymakers to move now rather than, say, 2 months ago.
The Federal Reserve Chair Jerome Powell indicated overnight that he sees 2 more rate cuts before the end of the year. Could this prompt China to do even more?
Well, I think what China is doing now is really working out what the anatomy of the fiscal stimulus package, which is going to complement the monetary easing, is going to look like. I wouldn't expect 2 more from the People's Bank over the next couple of months. I think they've fired their salvo. It's really up to the fiscal authorities to follow through, but also very importantly, state entities, whether that's local governments or state-owned enterprises, taking the gilt-edged invitation from the central authorities to actually start purchasing on the market unsold properties. That is the thing which could catalyse something more definitive on the real estate side. That's something I'll certainly be looking for between now and the end of the calendar year.
To what extent will China's efforts to support its own economy also support Australia's?
Well, yes, Australia is very leveraged into Chinese domestic demand as well as China's ability to service the rest of the world in manufacturing. We've already seen flow-through effects to iron ore. Some of the other commodities that Australia sends in that direction should also benefit. China's now got such a global footprint. It is the major trading partner of the majority of the world's nations, and Australia is really at the top of the list of those who do benefit when China is in an expansionary mode. But as we've already discussed, it's too early to tell how definitive the uplift will be or if there will be an uplift.
The iron ore price has moved higher in recent days, but Goldman Sachs yesterday said it's still expecting the price of iron ore to fall to $85 a tonne in the fourth quarter. What are the implications for Australia's economy, which is now growing at its slowest pace since the 1990s?
Look, where iron ore is concerned, the cost support range in this market is between 80 and 100 US dollars per tonne. So Goldman Sachs saying 85 US dollars per tonne. That's right in the middle of that range. We're trading higher than that today as a knee-jerk response to the good news of stimulus. I would suspect that won't last all that long. I think we'll be back in that 80 to 100 range before too long. That's going to put incredible pressure on the highest cost producers in the seaborne trade for this market. So juniors in the traditional basins exports out of the west coast of India, the highest cost Chinese producers, but not the big listed ASX companies, the household names. They will still be making very tidy margins and profits, anywhere within that 80 to 100 range and below. So I don't think $85 is a particularly striking number. If we were to hit it on an average basis, anywhere within that range I think is completely reasonable.
Huw McKay, thanks for joining us.
My pleasure.